Hello, I'm Michael Gray, CPA. I decided to record a special program for the Financial Insider Weekly site on YouTube because this law that was recently passed, the One Big Beautiful Bill Act, is a major piece of legislation. And so I thought it would could make it very helpful to people who have watched this program in the past to get some highlights related to this and to make it available on this site. So anyway, I hope you'll find this useful. And if you do, let your friends know about it. So I'm going to share my screen here and go ahead and start this PowerPoint presentation. Okay, so it's the One Big Beautiful Bill Act of 2025. I'm recording this on November 7th of 2025. The IRS is going to be continuing to issue guidance related to this. So this is sort of an alert. And if you have a tax advisor, I'd say it'd be a good idea to sit down and talk about how this is going to impact your taxes. So President Trump signed the One Big Beautiful Bill Act of 2025 on July 4th of 2025. Republicans in Congress responded to President Trump's request for urgency by enacting it mid-year. That's kind of unusual. Usually we get our tax law changes that are like right at the end of the year or maybe even uh, late into the next year, like in January. So we did get some advance notice on this particular legislation. The reason for the urgency is that most of the tax cuts in the Tax Cuts and Jobs Act of 2017 were scheduled to expire after 2025. Usually, major tax laws are passed at the end of the year. The act was narrowly approved 5150 in the Senate and 218 to 214 in the House of Representatives. The principal part of the act was to extend most of the cuts in the Tax Cuts and Jobs Act of 2017. According to the Congressional Budget Office, uh, this tax legislation will result in a 10-year decrease in revenues of about $4.5 trillion, partially offset by a decrease in spending of about 1.1 trillion, for a net decrease in the federal deficit of about 3.4 trillion. The spending cuts are for cutbacks in Medicaid, healthcare, food stamps, and student lunches, or the SNAP program, and a major rollback of green energy credits. The Congressional Budget Office estimates that 11.8 million people will lose their health insurance. The deficits result in increasing interest expenses in the federal budget that aren't sustainable. For 2025 fiscal year, 14% of U.S. government spending is for interest, tied with Medicare as the second largest budget item. So as I am recording this, we're in a government shutdown, and the Democrats in the Senate are holding out to try to restore some of the medical benefits that were cut back in this legislation. In addition, in a letter to House Budget Committee member Brendan Boyle, the Congressional Budget Office observed that under the Statutory Pay-as-You-Go Act of 2010, Medicare spending will automatically be cut by sequestration by about $490 billion for 2027 through 2034 unless Congress takes action. OBBBA does not include tariffs or import taxes. So far, businesses have largely absorbed new tariffs imposed by President Trump, which will reduce their profits. Eventually, they could be forced to pass through tariff costs to consumers. Combining tariffs with benefit cuts and tax cuts at the highest brackets represents a major shift of government funding to the poor and middle class. Now, the Supreme Court right now, again on November 7th of 2025, is looking at the issue as to whether President Trump actually had the power and the authority to impose these tariffs. So we'll see what happens. So keep an eye open on the news for that. There are significant tax planning opportunities in OBBBA, and our role, or my role, and the role of tax and legal advisors is to help our clients to use them. The act is huge, over 900 pages. All of the 900 pages aren't tax related, though. Anyway, in order to make it more digestible and so that you'll be aware of items requiring attention soon, I'm going to initially focus on the provisions taking effect during 2025, and I'll highlight provisions I believe will apply for you. And I'd say in your clients, I did this originally for attorneys and CPAs. The other provisions are also included in the outline with references to sections of OBBBA. Remember, these are federal tax changes. Check whether your state will conform to them. You can access the complete law at this address here. So I'm going to pause for a moment to give you a chance to write this down if you want to, or you can just look it up under One Big Beautiful Bill Act online, and there will be a link there where you can find the law, and you can search for provisions in the law. Okay, so I'm going to move on. So these are the tax provisions that are effective in 2025. So first is what they call the SALT cap, and SALT is short for state and local taxes. The itemized deduction ceiling for state and local taxes has been increased from $10,000 or $5,000 for married filing separately to $40,000 or $20,000 for married filing separately, effective for 2025, and $40,400 or $20,200 for married filing separately for 2026. The ceiling will be increased to 101% of the amount for the previous year from 2027 through 2029. After 2029, the ceiling will revert to $10,000 or $5,000 for married filing separately. The SALT cap is reduced to no less than $10,000 or $5,000 for married filing separately by 30% of the excess of the taxpayer's modified gross income over $500,000 or $250,000 for married filing separately for 2025 and $505,000 or $252,500 for married filing separately for 2026. The SALT cap phase-out threshold will be increased to 100%, 101% of the dollar amount in effect for the previous year from 2027 through 2029. The phase-out will create a bubble with an effective marginal tax rate of 45.5% for $100,000 of taxable income for most taxpayers and $50,000 for taxable income for married persons filing separately. Notice that so far the pass-through entity tax permitting deduction of state income taxes at the pass-through entity level. So this is where partnerships, LLCs, taxes, partnerships, and S corporations can pay the state taxes related to their income and then get the tax deduction. So it's a benefit for their owners. That has been preserved as a method of avoiding that SALT cap limitation for these business owners. So now we'll talk about Section 529 plan distributions. So Section 529 plans are qualified tuition programs. In California, we call them California scholarship accounts. Effective for distributions after July 4th, 2025, post-secondary credentialing expenses qualify for tax-free distributions from Section 529 plans. Post-secondary credentialing expenses include books, tuition, equipment, and testing fees for a course of study to obtain and continuing education to maintain an industry credential. This provision might provide some relief for students studying for the bar exam, CPA exam, or other professions. So next is the senior deduction. To satisfy President Trump's promise to make Social Security income tax exempt, Congress enacted an enhanced deduction for seniors of $6,000 for taxpayers who have attained age 65 by the year end. For joint returns, each spouse may claim $6,000 provided both spouses have attained age 65 by the year end. The individuals filing the income tax return must have and report Social Security numbers. Married persons must file a joint return to claim the deduction. No Social Security income is required to claim the deduction. Now, we're going to see these themes about having Social Security numbers throughout this legislation. And of course, that's to favor citizens and permanent residents who have green cards over illegal aliens or other aliens. The other thing is, I notice married persons must file a joint return to get the deduction. So that's going to be another theme. And the Republicans in Congress are trying to encourage married people to file joint returns. The deduction is treated as personal exemption, not an itemized deduction, although personal exemptions have been otherwise repealed. The senior deduction is phased out by 6% of modified adjusted gross income over $75,000, or $150,000 for a joint return. The deduction applies for tax years 2025 through 2028. So notice another thing that a lot of the breaks that President Trump had promised phase out. They go away after 2028. So we only get them for a limited amount of time unless Congress extends them. Overtime deduction, a deduction of up to $12,500 or $25,000 for a joint return may be claimed for qualified overtime compensation received by an individual during a tax year. The deduction is not an itemized deduction. Qualified overtime compensation is compensation paid in excess of the regular rate where the individual is employed. Tips are excluded from compensation when computing this deduction. The amount of overtime compensation must be reported on the employee's W-2. The deduction is phased out by $100 for each $1,000 that modified adjusted gross income exceeds $150,000 or $300,000 for a joint return. The individuals filing the income tax return must have and report Social Security numbers. Married persons must file a joint return to claim the deduction. And the overtime deduction applies for 2025 through 2028. So for 2025, the IRS is waiving the requirement to report this overtime on the W-2. So, but the employers are still going to have to provide this information to their employees so they have the information to claim the deduction. Okay, the child tax credit. Child tax credit is permanently increased to $2,200 per child effective for 2025 and indexed for inflation after 2025. Now, when I say permanently, it means until Congress changes it in the future, or unless Congress changes it in the future. The refundable $1,400 child tax credit indexed for inflation at $1,700 for 2025 is made permanent with the income threshold amounts of $200,000 or $400,000 for a joint return. The $500 non-refundable credit for a dependent other than a qualifying child is also made permanent. The requirement that the child's Social Security number must be provided to claim the credit is made permanent. The work-eligible Social Security number of a single taxpayer or at least one spouse on a joint return must also be reported on the income tax return to claim the credit. So adoption tax credit, effective for tax years beginning after December 31, 2024, up to $5,000 indexed for inflation of the adoption tax credit is refundable. The refundable amount may not be carried forward. Well, if it's refundable, you're not going to be carrying it forward. Hopefully you'll get a refund. Okay, bonus depreciation. Bonus depreciation is available in the year of acquisition for makers property. So makers is an accelerated depreciation schedule that we have. Anyway, for makers property with a recovery period of 20 years or less, provided the property isn't required to be depreciated using the alternative depreciation system. So you would usually use the alternative depreciation system for foreign assets, assets that are offshore. Also, you may make an election to claim an alternative depreciation for the interest deduction, but that's not so critical as it once was, as you'll see in a few minutes. Bonus depreciation is also available for specified plants when they are planted or grafted. So plants, we're talking about, bushes, uh, trees, like for walnuts and almonds, things where we're getting crops from these plants. Anyway, qualified real property and off-the-shelf computer software that is otherwise depreciable over 3 years also qualifies for bonus depreciation. The first year depreciation cap for luxury vehicles is increased by $8,000. Before OBBBA was enacted, bonus depreciation was 40% of the basis of the property for 2025 and 20% for 2026 and would expire after 2026. So now we're getting the 100% instead of these lower percentages. OBBBA extends bonus depreciation permanently and increases the rate to 100% for property acquired and placed in service on or after January 19th, 2025, and for specified plants planted or grafted on or after January 19th, 2025. So notice this cutoff is the property acquired and plants planted or grafted. So if you pay for these things after January 19th, 2025, but they were acquired before that date, then they are not going to qualify for bonus depreciation for 2025 or any year. Section 179 expenses. So tangible, new, or used Section 1245 property that's depreciable under the modified accelerated cost recovery system that is required by purchase for use in the active conduct of a trade or business and used predominantly in the United States and predominantly more than 50% for business purposes is eligible for Section 179 expensing in the year acquired. So this again is an expensing election. In most cases, bonus depreciation would be more advantageous, but this is just another choice that we have. The maximum amount eligible for Section 179 expensing for an SUV with a gross vehicle unloaded weight of 6,000 pounds and exempt trucks with an interior cargo bed length of less than 6 feet and exempt passenger vans that seat fewer than 10 persons behind the driver's seat is $31,300 for 2025. Qualified real property and off-the-shelf computer software that is otherwise depreciable over 3 years also qualifies for Section 179 expensing. When an election is made to claim Section 179 expensing for qualified real property, all qualified real property acquired that year is treated as Section 179 property. The deduction is limited to taxable income before the deduction. And then you can carry this amount forward if you don't deduct in that year, and then you test it for taxable income in later years. Before OBBBA was enacted, the maximum basis eligible for Section 179 expensing was $1,250,000 for 2025, with a phase out for the basis of qualifying property exceeding $3,130,000. Effective for property placed in service in tax years beginning after December 31, 2024, OBBBA increases the maximum Section 179 deduction to $2.5 million, with a phase out when the basis of property acquired exceeds $4 million. The thresholds are adjusted for inflation for tax years beginning after 2025. So I'm located in San Jose, which is California, which is Silicon Valley, part of Silicon Valley. And so this is a very important item for businesses in our area relating to expensing research and experimentation expenses. So effective for tax years beginning after December 31, 2024, domestic research and experimentation expenses that are required to be amortized over 15 years may be expensed. Research and experimental expenses for work done outside the United States must still be amortized over 15 years. Under a transitional rule, small business taxpayers with average gross receipts of 31 million or less may apply this change retroactively to tax years beginning after December 31, 2021. So that is when there is a provision in the Tax Cuts and Jobs Act of 2017 that started requiring amortization of research and experimentation expenses for tax years beginning after December 31, 2021. So in this case, the small business taxpayers are going to be able to deduct amounts that they couldn't before currently. Under another transitional rule, all taxpayers that made domestic research or experimental expenses after December 31, 2021 and before January 1st, 2025 may elect to either amend tax returns to change the deductions from amortization to expensing or accelerate the remaining deduction for those expenses over 1 year or 2 year periods. On August 28, 2025, the IRS issued Revenue Procedure 2025-28, providing guidance about the procedures for making the change. The revenue procedure indicates at Section 3.03 that a small business taxpayer may make the election to currently deduct domestic research expenses on an originally filed 2024 income tax return. Taxpayers who already filed income tax returns and didn't apply for an extension of time to file are automatically granted a 6-month extension of time to file a superseding income tax return and issue corrected Schedule K-1s. So the extension period has expired for calendar year returns. Most of them had due dates on September 15th or October 15th. However, fiscal year corporations may still have time for making that election to deduct these on the fiscal year that includes January 2024. Rules are provided to coordinate the immediate deductibility of domestic research and experimental expenditures with the research credit. Now I'll talk about the cap on deducting business interest. A taxpayer's deduction of business interest expense paid or incurred for the tax year is generally limited to the sum of the taxpayer's business interest income for the year, excluding investment income, 30% of the taxpayer's adjusted taxable income, but not less than zero, and the taxpayer's floor plan interest. So that's like auto dealers that finance their inventory. The limit doesn't apply for businesses that meet a small business test if their average annual gross receipts for the 3 prior years doesn't exceed a threshold amount, which is 31 million for 2025. The limit also doesn't apply for certain specified businesses. Effective for tax years beginning after December 31, 2025, under OBBBA, the limit is increased by adding back deductions for depreciation, amortization, and depletion to compute adjusted taxable income. So this is increasing the limitation amount. Effective for tax years beginning after December 31, 2024, the definition of motor vehicle is changed to include trailers and campers designed to be towed or affixed to a motor vehicle, allowing the interest paid for flooring these items uh, to be included as for the taxpayer's floor plan interest. So this is another new item that's going to be important for businesses that are manufacturers. First year depreciation for qualified production property. Effective for qualified production property placed in service after July 4th, 2025, a first year depreciation allowance is allowed of 100% of the adjusted basis of qualified production property. Qualified production property is non-residential real property, which is used by the taxpayer as an integral part of a qualified production activity, which is placed in service in the United States or possession of the United States, the original use of which begins with the taxpayer, or of which the construction, reconstruction, or erection by the taxpayer begins after January 19th, 2025, and before January 1st, 2029, and is placed in service after July 4th, 2025, and before January 1st, 2031, except in cases of acts of God, in which case the Secretary of the Treasury can extend the date up to 2 years. Qualified production property does not include the portion of any non-residential real property used for offices, administrative services, lodging, parking, sales activities, software development, or engineering activities, or other functions unrelated to manufacturing, production, or refining of tangible property. Qualified production activity also does not include any property to which the alternative depreciation system applies, again, offshore property, for example, or any food or beverage prepared in the same building as a retail establishment in which the property is sold. The qualified production activity is the manufacturing, production, or refining of a qualified product. The activities of the taxpayer must result in a substantial transformation of the property comprising the product. Under a special acquisition rule, a taxpayer may claim the qualified production property deduction for non-residential property, real property, which is acquired by the taxpayer after January 19th, 2025, and before January 1st, 2029. Two, which was not used in a qualified production activity at any time during the period beginning January 1st, 2021 and ending on May 12th, 2025. Three, which was not used by the taxpayer or related party at any time prior to such acquisition. Four, which is used by the taxpayer as an integral part of a qualified production activity. Five, which is placed in service in the United States or possession of the United States. And six is placed in service after July 4th, 25 and before January 1st, 2031, except in cases of acts of God, in which case the Secretary of the Treasury can extend the date by up to 2 years. Recapture rules apply when the use of the property changes during the 10-year property after the qualified production property is placed in service. Employer-provided child tax credit, effective for tax years beginning after December 31, 2024. The percentage of employer-provided child care expenses allowed as a tax credit is increased from 25% to 40%, and the maximum credit is increased from $150,000 to $500,000 to be adjusted for inflation after 2026. For 2025, a business must spend at least $1.25 million on child care expenses to receive the full credit. And that's just, multiply 1.25 million times 40%, and you're going to get the 500,000. For small businesses, the percentage of employer-provided child care expenses allowed as a tax credit is increased to 50%, and the maximum credit is increased to 600,000 to be adjusted for inflation after 2026. To receive the maximum credit for 2025, a small business must spend at least 1.2 million on child care related expenses. An eligible small business must meet a gross receipts test 31 million for 2025 based on the 5-year period increased from a 3-year period preceding the tax year. So um, if you're an employee that needs childcare, uh, for your child, uh, maybe you could talk to your employer about this, that they could get a tax benefit by providing that benefit for you. Notice the 600,000, it's half of the 1.2 million that I said for the getting the maximum credit. Small businesses are allowed to pool their resources to provide childcare to their employees and may use a third-party intermediary to facilitate childcare services on their behalf. So small businesses can get together so that they can provide this hopefully cost effectively for their employees. Okay, this is another important one for Silicon Valley or any place where you have businesses that are making new offerings of the stock or startup businesses. Qualified small business stock gain exclusion. Before the adoption of OBBBA, non-corporate taxpayers could exclude from gains gross income for the sale or exchange of qualified small business stock held for more than 5 years. The exclusion is 100% of the gain for qualified stock acquired after September 27th, 2010, 75% of the gain for qualified stock acquired after February 17th, 2009 and before September 28th, 2010, and 50% of the gain for qualified stock acquired before February 18th, 2009, and it's increased to 60% of the gain attributable to periods before 2019 if the stock was issued by a corporation in an empowerment zone and acquired after December 21, 2000. Now, notice this is what the rules were before. The stock acquired before September 28, 2010, 7% of the excluded gain is a tax preference item for alternative minimum tax reporting. Excludable gain on dispositions of qualified stock from any single issuer for a tax year is limited to the greater of $10 million, reduced by the aggregate amount excluded for the issuer's stock in prior years, or $5 million for married filing separately, or 10 times the taxpayer's adjusted basis in all the issuer's stock disposed of during the tax years. Gains on dispositions of qualified stock held by a pass-through entity, like a partnership or an S corporation, for more than 5 years is passed through to partners, shareholders, and participants who held interest in the entity when it acquired the stock and at all times thereafter. The exclusion can't reflect any increase in the person's share of the entity after the entity acquired the stock. Qualified small business stock is stock issued after August 10th, 1993 and acquired by the taxpayer at the original issue, directly or through an underwriter, in exchange for money or property or as compensation for services provided to the corporation. The issuing corporation must be a domestic C corporation other than a regulated investment company, cooperative, or other pass-through corporation. Both before and immediately after the qualified stock is issued, the corporation's aggregate assets must not exceed $50 million, with parent subsidiary controlled groups treated as one corporation. During substantially all of the taxpayer's holding period, at least 80% of the value of the corporation's assets must be used in the active conduct of qualified trades or business. Sorry. So qualified business does not include a business that provides services in the fields of law, engineering, architecture, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, or any trade or business if its principal asset is the reputation or skill of employees. Hospitality, farming, insurance, finance, and mineral extraction are also not qualified businesses. OBBBA changes the gain exclusion by creating tiers effective for stock issued or acquired and to tax years commencing after July 4th, 2025. So in other words, a lot of those old rules are still going to apply for previously acquired stock. This is for stock that's acquired after July 4th, 2025. The exclusion ratios are 50% after 3 years, 75% after 4 years, and 100% after 5 years. The per issue dollar cap for post-enactment shares is increased from 10 million to 15 million, indexed for inflation after 2026. The post-enactment aggregate asset ceiling is increased from 50 million to 75 million, indexed for inflation after 2026. And there is no alternative minimum tax preference for the excluded gains for these shares. So notice that the thresholds have been increased quite a bit, about 50%. So anyway, some more stock is going to be eligible for this exclusion. Okay. Okay, payments by partnerships to partners for property or services effective for services performed and property transferred after July 4th, 2025, with no inference for the treatment of prior transactions. Internal Revenue Code Section 707A2 is changed from under regulations prescribed to except as provided. Under Section 707A, transactions between a partner and a partnership for property and services are generally treated the same as between a partnership and a person who isn't a partner. So the reason why this was added is that basically um, uh, they wanted to disregard regulations that had been previously issued by the IRS and stick pretty much to the code. Okay, residential housing exception for percentage of completion accounting. So this applies for construction companies, residential housing construction, effective for contracts entered into in taxable years beginning after July 4th, 2025. An exception from the requirement to use percentage of completion accounting is changed from home construction to residential housing construction. The maximum estimated time when the contract is entered into is increased from 2 years to 3 years. Okay, so this is a big section because remember we said that the tax cuts mostly go to the wealthy, but anyway, whatever tax cuts that were enacted were paid for partly by accelerated sunset for clean energy provisions. So most of the clean energy provisions enacted by the Inflation Reduction Act of 2022 have been repealed by moving up their expiration dates. Most of them were scheduled to expire at the end of 2032 or 2034. The previously owned clean vehicle credit is terminated for vehicles acquired after September 30th of 2025. The clean vehicle credit is terminated for vehicles acquired after September 30th of 2025. So we had a last hurrah that happened for people to get the 7,500 credit um, by acquiring them by September 30th of 2025. That is now passed. The qualified commercial clean vehicle credit is terminated for vehicles acquired after September 30th, 2025. The alternative fuel vehicle e-fueling property credit is terminated for property placed in service after June 30th of 2026. The energy efficient home improvement credit is repealed for any expenditures made after December 31 of 2025. The residential clean energy credit is terminated for any expenditures made after December 31 of 2025. The energy efficient commercial buildings deduction is terminated for property, the construction of which begins after June 30th of 2026. So notice I did include a few items here that took effect in 2026 because I just kept all of these together. The new energy efficient home credit is terminated for homes acquired after June 30th of 2026. Special 5-year cost recovery for certain energy property is terminated for property the construction of which begins after December 31, 2024. The clean hydrogen production credit is terminated for facilities the construction of which begins on or after January 1st, 2028. So related to the material that we were just going through. So there is still time to take advantage of some of these, particularly for, like home energy credits and so forth. So, so you should be talking to your tax advisors and looking into uh, to taking advantage of those if you still want to. Things like the solar credit, solar energy uh, generation for electricity for your home. Okay, so the 1 month deferral of foreign income has been repealed. Generally, a foreign corporation that has a majority U.S. shareholder must adopt the tax year of its U.S. shareholder. An election was available for specified foreign corporations to adopt a tax year ending 1 month earlier than its U.S. shareholder, which could get like a 11-month deferral, effective for taxable years beginning after November 30th of 2025. The 1 month deferral election is repealed. So sorry, it wasn't 1 month, wasn't an 11-month deferral. It's 1 month deferral. That was what was available before, and now that is no longer available. So there was something that I'm just thinking about. I'm just going to grab my book here. Ugh. Sorry. So I had dropped the thing for the tips deduction, and so I want to be sure I'm giving you the right information here. Okay. So an individual can claim an income tax deduction for qualified tips received in tax years 2025 through 2028. And so this was the no tax on tips promise that President Trump made. So the qualified tip deduction can't be more than $25,000 per tax year. And then the deduction amount is reduced, but not below zero, by $100 for each $1,000, by which the taxpayer's modified gross income exceeds 150,000 or 300,000 for married individuals filing a joint return. Um, so the IRS has issued some guidance related to this that you can find at the IRS website. Um, the employers are supposed to, again, include this on the W-2. It's too late to change the W-2 forms for 2025. So they said the employers should just provide this information to employees. Um, the qualified tips are amounts received that are paid voluntarily and without any consequence of non-payment and is not the subject of negotiation and is determined by the payer. The trade or business in which the individual receives the amount is a, excuse me, this is if it's not a qualified tip if it's not paid voluntarily. So, for example, if you're like me, okay, you've gone to dinner at a restaurant and then they have a clause that says if you have six or more people, there will be a standard service charge of 15%, usually 20% or more. And so that specified amount, since it's not voluntary, it's it doesn't qualify for the tips deduction. So it has to be a voluntary amount. The trade or business in which the taxpayer receives the amount, if it's not a specified trade or business, then it won't qualify. So it has to be a business where tips are customarily paid. So, for example, a CPA firm, a law firm, uh, you know, they don't typically get tips, so they are not going to qualify. And other requirements established by the Treasury Secretary and regulations or other guidance are satisfied. So anyway, so just be aware of that if you are in an occupation where you get tips. You need to check in, and there's some weird things. So, for example, okay, it, if you are a person, for example, that is a performer, and so let's say you're performing in the lobby of a hotel, you're playing piano, and you're employed by the hotel. You're going to get a W-2 from the hotel, and you get tips uh, from some of the patrons. Well, those tips do qualify for the tips deduction. However, if you are, let's just say you're performing, you're a street performer, and you're busking, okay, at a farmer's market, and you get tips. Those tips do not qualify for the tips deduction because it's a specified service, uh, greater business. Performing arts is one of the specified businesses. So be alert for that. And, it just seems weird that you could be doing the same thing in two different situations. In one, you qualify for the tips deduction, and the other one you don't. Okay, so back to our, oh, oh dear. Okay, sorry about that. Okay, so let's go through some tax provisions effective after 2025. So this is the biggie in a sense related to the whole act. Permanently effective for tax years beginning after December 31, 2025. OBBBA extends the individual income tax rates adopted in the Tax Cuts and Jobs Act of 2017. The maximum federal income tax rate for individuals, estates, and trusts scheduled to increase to 39.6% is 37%. The threshold for the 20% maximum long-term capital gains rate is also extended and indexed for inflation. The act adds an additional year inflation adjustment for the 22% tax bracket by adjusting the base year. So the people, of course, who benefit the most from this, because they're the people in these high tax brackets, are the very wealthy. Well, I shouldn't say the very wealthy, the very high income taxpayers. And so that's what some of the controversy about this whole legislation is about because many people in the lower brackets don't get the benefits that the people in the higher brackets do in a sense. Well, a lot of them don't even pay very much income taxes. But the other thing, of course, is that their health care is going to be cut back and so forth. And some of their unemployment has been cut back uh, for certain people and so forth. So anyway, so in a sense, it's robbing the poor uh, to give to the rich. And so we'll see how things pan out related to all of this, but that's what the law is right now under OBBBA. Okay, the increased standard deduction has been made permanent as the standard deduction is slightly increased effective 2026 to $15,750 for singles, 23,625 for heads of households, and $31,500 for married filing joint returns indexed for inflation in future years. So the higher standard deduction has resulted in many people that used to itemize before the Tax Cuts and Jobs Act of 2017 took effect to claim the standard deduction and not be itemizing anymore. And so that's going to continue to some extent, but then we've got this increase in the deduction for state and local taxes. So for some places, you pay quite a bit of real estate taxes for your residence and then pay some pretty good income taxes. And that can kick you over these, and and also depending other things that you may do, donations and so forth. The estate and gift tax lifetime exemption has been made permanent. So the estate and gift tax lifetime exemption is increased to 15 million effective 2026 and indexed for inflation for subsequent years. So there was a lot of shuffling that was going around tax planning to try to avoid the exemption was going to be cut in half, basically, and after 2025, but now that's not the case. Okay, the alternative minimum tax exemption and phase-out amounts have been modified and made permanent. So this is an important one for, again, some higher income taxpayers that may be subject to the alternative minimum tax. So effective for tax years beginning after December 31, 2025, the alternative minimum tax exemptions adopted for individuals in the Tax Cuts and Jobs Act of 2017 are extended with annual inflation adjustments slightly modified using different base years. The Tax Cuts and Jobs Act of 2017 didn't change the AMT exemptions and the phase-outs for estates and trusts. The thresholds for phasing out the exemptions are reduced from 1,252,700 for married filing joint and surviving spouses for 2025 to 1 million for 2026, indexed for inflation thereafter, and from 626,350 for singles and heads of households for 2025 to 500,000 for 2026, indexed for inflation thereafter. So since we have lower thresholds, some people may be subject to alternative minimum tax that wouldn't have been under OBBBA, before OBBBA, I'm sorry, before OBBBA. The exemption phase-out rate is increased from 25% to 50%. So the exemption is phased out twice as fast under the new law. So again, this is going to subject certain people to alternative minimum tax. So examples of things that can kick you in is, again, if you have high state taxes, it's a contributing factor. Uh, Most of your deductions, your itemized deductions, get kicked under the alternative minimum tax, although charitable contributions. Another item, though, a big one here in Silicon Valley is incentive stock options. So when you exercise an incentive stock option, the excess of the fair market value over the option price for the stock is an adjustment for the alternative minimum tax. And so this can throw some of those tech workers particularly into the alternative minimum tax. Okay, there's some more information here for qualified tuition programs, Section 529 plans. Effective for tax years beginning after December 31, 2025, the annual limit for distributions for a beneficiary from 529 plans is increased from 10,000 to 20,000. So this limitation actually relates to things like uh, private schools. When the tuition's paid for private schools, we have this type of limitation that applies. It doesn't apply for like college expenses. Okay, and then I already covered other changes for 2025. Okay, qualified residence interest effective for tax years beginning after December 31, 2025. The limit for deducting qualified residence interest is permanently 750,000 of acquisition indebtedness. Home equity indebtedness, other than acquisition indebtedness, doesn't qualify as qualified residence interest. So this was a major change in the Tax Cuts and Jobs Act of 2017 that continues to apply. And it's particularly important here, for example, in California, where we have homes that typically are selling for 1 million and more. For example, here in Silicon Valley, it's Santa Clara County, and San Francisco, Los Angeles. Effective for taxes beginning after December 31, 2025, mortgage insurance premiums, which were previously deductible for 2018 through 2021, are treated as interest on acquisition indebtedness. The deduction related to mortgage insurance premiums is phased out for taxpayers with adjusted gross income above $100,000 or $50,000 for married filing separate returns, by $100 for each thousand, or $500 for married filing separate returns in excess of the threshold amounts. Okay, miscellaneous itemized deductions have been repealed except for educator expenses. So effective for tax years beginning after December 31, 2025, the deduction for miscellaneous itemized deductions is permanently repealed, and unreimbursed employee expenses for eligible educators is removed from the list of miscellaneous itemized deductions. So in other words, you're not subtracting the 2% of adjusted gross income from the educator expenses. Expenses of an eligible educator are tax deductible. An eligible educator is an individual who is a kindergarten through grade 12 teacher, instructor, counselor, or interscholastic sports administrator or coach, principal, or aide in a school for at least 900 hours during a school year. So again, this is an itemized deduction. So if you don't itemize, you're not going to get the deduction. Unreimbursed employee expenses for eligible educators include expenses for book supplies, computer equipment, and supplementary materials used by eligible educators as part of instructional activity. And overall, on the benefit of itemized deductions. So we used to have this thing called the Pease limitation on itemized deductions that applied before the Tax Cuts and Jobs Act of 2017 became effective. And it was to be restored after December 31 of 2025. It's permanently repealed, so I'm not going to go through the details on that. It's been replaced by a new limitation effective for tax years beginning after December 31, 2025. Under the new limitation, itemized deductions after applying other limitations are reduced by 2/32 of the lesser of the amount of itemized deductions or the amount of taxable income before itemized deductions over the threshold for the 37% tax bracket. Okay, so again, it's mostly the very high income taxpayers that are going to be subject to that 37% tax bracket. Most of us are going to have to deal with that. Okay, extension and modification of exclusion for discharges of student loans, effective for discharges after December 31, 2025. The Tax Cuts and Jobs Act allowing the exclusions of income of student loans discharged because of an individual's death or permanent disability has been extended permanently. The exclusion applies for a student loan or a private education loan. In order to qualify for the exclusion, the taxpayer must provide a work-eligible Social Security number. An American Rescue Plan Act provision extending the exclusion to all student loan discharges is allowed to expire. It's expiring, going away as of December 31, 2025. Okay, so now I'm going to talk about Trump savings accounts and a contribution pilot program. Brace yourselves. Anyway, so effective January 1st of 2026, parents of any child under the age of 8 may open a Trump account for their child. The first contribution can't be made until 6 months after July 4th of 2025. So that means it's not going to be available until 2026. Okay, the accounts may receive contributions from parents, relatives, and other taxable entities, and from other nonprofit and government entities facilitated by the Treasury Department. To be eligible for an account, the child must be a U.S. citizen, and at least one parent must provide their work-eligible Social Security number. So again, permanent resident aliens aren't going to qualify for this particular benefit. So Trump accounts are kind of traditional IRA that must be invested in diversified funds that track an established index of U.S. equities. No margin is permitted for account investments. Contributions to Trump accounts don't count for the contribution limits for other retirement accounts, and the account isn't aggregated with other IRAs for the purpose of determining required minimum distributions or the taxability of distributions. Taxable entities may make aggregate contributions up to $5,000 annually of after-tax dollars to a Trump account. Contributions from tax-exempt entities aren't subject to the $5,000 annual limit. The limit will be indexed for inflation after 2027. Contributions aren't counted for determining the tax basis of the account. Contributions from unrelated third parties must be provided to all children within a qualified group. So, for example, all children in a state, a specific school district, or educational institution. Employers may contribute up to $2,500 to an employee's child's Trump account, and the contribution isn't included in the employee's taxable income. So here's a little tax-free benefit. The limit will be indexed for inflation after 2027. No contributions can be made to a Trump account after the beneficiary reaches age 18. The account may be transferred tax-free to a different custodian using a trustee-to-trustee transfer. So trust account holders can't make distributions until they reach age 18. From age 18 to 24, account holders may access up to 50% of funds for higher education, training programs, small business loans, or first-time home purchases. At age 25, account holders may withdraw any amount up to the full balance for those limited purposes. At age 30, account holders may withdraw up to the full balance of the account for any purpose. Now, distributions taken for qualified purposes, like education, are taxed as long-term capital gains. Distributions taken for any other purpose are taxed as ordinary income. So notice there's no tax deduction for putting the money in these accounts. But when you take the money out, it's all going to be ordinary income or capital gain. It's all going to be taxable. So if the beneficiary of the account dies before the year that includes their 18th birthday, so one, if the successor to the account is not an estate, the successor will be taxed on the account balance for the year of death. Two, if the successor to the account is an estate, the account balance will be taxed on the final income tax return of the account beneficiary. So remember, most distributions from Section 529 plans or qualified tuition plans used for qualified education expenses are tax-free, which I think is a better alternative for family savings plans. However, if you've maxed out your contributions to a 529 plan, that you might think about using one of these plans, these Trump accounts. As a pilot program for U.S. citizens born from January 1st, 2024 and December 31, 2028, the federal government will contribute $1,000 per child into every eligible account. Parents or guardians of newborn children may open an account and receive the $1,000 contribution. To be eligible for the $1,000 contribution, the child must be a U.S. citizen at birth, and both parents must provide work-eligible Social Security numbers. If the Secretary of the Treasury, being the IRS, or delegated to the IRS, if they determine that an eligible individual doesn't have an account by the first tax return where the parents claim the child credit, the Secretary shall establish an account. If possible, the account will be open with the parent's preferred custodian and investment fund. Parents will have the options to opt out of the account. So this is a gift. And so, yes, you may as well take this, but you had to find a custodian for the account. and this is a pretty small balance. Um, so anyway, the Republicans in Congress are trying to encourage people to increase the birth rate and to give a gift for having a child. But we all know that this is a drop in the bucket as far as what it takes to raise a child. Okay, Dependent Care Assistance Program, effective for tax years beginning after December 31st, 2025. The exclusion for employer-provided dependent care assistance is increased from up to $5,000 annually, or $2,500 for married filing a separate return, to $7,500 annually, or $3,750 for married filing a separate return. Child Independent Care Credit. So we have the child credit, but now this is the child independent care credit. So like, if you have a babysitter or a daycare center and so forth for your child. Also, summer camp, if you're both working, can qualify. Effective for tax years beginning after December 31, 2025. The maximum child independent care credit rate is increased from 35% to 50%. Reduced by 1% for each $2,000 or fraction thereof by which the taxpayer's adjusted gross income exceeds $15,000. For adjusted gross income between 43,000 and 75,000, or 86,001 and 150,000 for married filing joint, the credit rate is 35%. For adjusted gross income between 75,001 and 105,000, or 150,001 and 210,000 for married filing joint, the credit is phased down to 20% by 1% for each 2,000 or 4,000 for married filing joint in excess of 75,000 or 150,000 for married filing joint. Okay, health savings account enhancements. Effective for months beginning after December 31, 2025. Individuals with high deductible health plans also will be able to enroll in direct primary care or DPC arrangements and maintain their health savings account or HSA up to 150 per month for individuals and 300 per month adjusted annually for inflation of HSA funds may be used to pay for DPC services. Effective for months beginning after December 31, 2025, all bronze and catastrophic health plans on the exchange are eligible plans for the purpose of making HSA contribution. So normally the plans are high deductible plans, and so basically they're saying that the bronze and catastrophic health plans will qualify. Okay, charitable contributions for individuals effective for tax years beginning after December 31, 2025. Taxpayers who don't itemize may claim a permanent deduction of up to $1,000 for single filers, $2,000 for married filing jointly. The donations must be made in cash, and the charity can't be a donor advised fund. So in other words, you don't itemize deductions, and you make some cash contributions, and you get the qualified receipt. Then you can take a separate deduction for those donations. And it's a below the line deduction. We're going to have a lot of changes to the tax forms. Also effective for tax years beginning after December 31, 2025, and for taxpayers who itemize deductions, the charitable contributions deduction before other limits is reduced by 0.5% of the taxpayer's contribution base for the tax year, which is adjusted gross income without regard to any net operating loss carryback. The disallowed deduction due to this limitation is added to the charitable contributions carried forward only when the remaining donations exceed the other AGI limits. There is an ordering rule for which limitations group the 0.5% reduction. The 60% of AGI limitation for cash contributions scheduled to expire after 2025 is made permanent. So again, this is for itemized, that was for itemized deductions. Casualty loss changes for individuals effective for tax years beginning after December 31, 2025, a limitation to deduct casualty losses to federally declared disasters is permanently extended. In addition, state-declared disasters, including U.S. territories, and mayor-declared disasters for the District of Columbia are eligible for the deduction. So that's a big change. It doesn't have to be a federal declared disaster after December 31 of 2025. Okay, now this is another important for small business owners. Qualified business income deduction has been extended. Effective for tax years beginning after December 31, 2025, the 20% qualified business income or QBI deduction under Section 199A is permanently extended. The phase-in threshold where limitations are applied to the deduction are increased from 50,000 to 75,000 for non-joint returns and 100,000 to 150,000 for joint returns. A new minimum deduction is adopted of $400 for taxpayers with at least $100,000 of QBI from one or more active trades or businesses that the taxpayer materially participates in. Okay, enhancement of employer-provided child tax credit. Effective for tax years beginning after December 31, 2025, the maximum employer child care credit is increased from 150,000 to 500,000, and the percentage of child care expenses covered is increased from 25% to 40%. So a business that spends at least 1.25 million could receive the full credit. Eligible small businesses may receive a 600,000 maximum credit with 50% of child care expenses covered. Qualified small business that spends at least 1.2 million on child care expenses could receive the full credit. An eligible small business meets an average annual gross receipts test would be 31 million for 2025, based on the 5-year period instead of the 3-year period preceding the tax year. The gross receipts threshold is adjusted annually for inflation. The 500,000 and 600,000 thresholds are also indexed for inflation after 2026. Small businesses may pool resources to provide childcare to their employees, and businesses may use a third-party intermediary to facilitate childcare services. Extension and enhancement of paid family leave and medical leave credit. Effective for tax years beginning after December 31, 2025, the paid family and medical leave credit for wages paid to qualifying employees for leave under the Family and Medical Leave Act is extended permanently with 3 changes. So 1, it modifies the credit to allow it to be claimed for an applicable percentage of the premiums paid or incurred by an eligible employer during a tax year for insurance policies that provide paid family and medical leave for qualified employees. It makes the credit available in all states, and it reduces the minimum employee work requirement from 1 year to 6 months. The applicable percentage starts at 12.5% of wages and increases to 25% for each percentage point the payment rate for leave exceeds 50% of wages. A maximum of 12 weeks of leave for each employee is eligible for the credit. No tax deduction is allowed for expenses for which the credit is claimed. Okay, this is another important one for investors, the renewal and enhancement of opportunity zones. A permanent opportunity zone policy is established built on the original structure. Rolling 10-year opportunity zone designations are created beginning on January 1st, 2027. The existing designation process is modified to update the definition of a low-income community, or ILC. And, okay, that's supposed to be an LIC, I'm sorry. And eliminating the ability for continuous tracts that are not LICs to be designated as opportunity zones. The definition of a low-income community is reduced to census tracts that have a poverty rate of at least 20% for a median family income that does not exceed 70% of the area median income. A guardrail is also added to ensure the term low-income community does not include any census tract where the median family income is 125% or greater of the area median family income. The taxpayer benefits are changed so that investors receive incremental reduction in gain starting on the first anniversary of the investment. Investors will be required to realize their initial gains reduced by any step-up in basis in the seventh year of the designation window. For each year that an investor is invested in the fund, their basis will increase by 1% for years 1 through 3, 2% for years 4 through 5, and 3% for year 6. In addition, a new type of qualified opportunity fund is created that invests solely in rural areas. Investments in these qualified rural opportunity funds will receive triple the step-up in basis. A special rule is also created that lowers the substantial improvement threshold of existing structures from 100% to 50% in rural areas. Additional reporting requirements are adopted for the Opportunity Zone program, and the IRS is given funding to carry out the reporting requirements. Okay, 1% for corporate charitable deductions effective for tax years beginning after December 31 of 2025. C corporations, so these are regular corporations, not S corporations. They may only deduct charitable contributions that exceed 1% of taxable income or the 1% floor and don't exceed 10% of taxable income. Charitable contributions disallowed because of the 1% floor may be carried forward up to 5 years, provided the 10% of taxable income threshold is exceeded. Current year contributions are applied first for the 10% limit. Charitable contribution carry-forwards are reduced to the extent they would increase a net operating loss. So this is a tax relief measure here. Increased thresholds for filing forms 1099 NISC and 1099 NEC. So these are the forms that are given to independent contractors or for miscellaneous income like prizes and awards. These information returns are usually required. Anyway, effective for payments made after December 31, 2025, the threshold for payments for which Form 1099 miscellaneous and Form 1099 NEC are required to be filed has increased from $600 to $2,000, indexed for inflation for tax years beginning after December 31, 2026. So that 600 threshold was there for many, many years, and so it's about time that it was increased. Okay, extension and modification of the limit on excess business losses of non-corporate taxpayers. Effective for tax years beginning after December 31, 2026, the limit for excess business losses of non-corporate taxpayers is made permanent. Effective for tax years beginning after December 31, 2025, the inflation adjustment for the 250,000 or 500,000 for married filing joint threshold for excess business losses will apply to tax years beginning after December 31, 2025. The base year for cost of living adjustments will be 2024. A business interest limitation effective for tax years beginning after December 31, 2025. Internal Revenue Code Section 163J is amended to provide that the business interest limitation is calculated before applying any interest capitalization provision, defined as any provision under which interest is required to be charged to a capital account, or two may be deducted or charged to a capital account. So capital account usually means it's being capitalized to the cost of an item that's financed. Anyway, any interest which is capitalized under Internal Revenue Code sections 263G or 263 Cap AF is not treated as business interest for Internal Revenue Code section 163J. The amount of business interest allowed after applying the limitation is applied first to amounts which would be capitalized and the remainder, if any, to amounts which would be deducted. No portion of any business interest carried forward is treated as business interest to which interest capitalization applies. Okay, so this is another one that's particularly going to affect aliens that are living in the United States, and they're trying to help out relatives overseas. Effective for transfers made after December 31, 2025, a 1% excise tax is imposed for transfers of funds outside the United States. Its tax applies to funds transferred using a service provider other than a bank. So, for example, Western Union would be one of these uh, transfer agents. The tax applies for cash, money orders, cashier's checks, or any other similar physical instrument. So when you go to the post office and you buy a money order to send to your relatives, then this remittance transfer tax could apply. The service provider collects the tax and pays it to the federal government quarterly. Remittance transfer tax doesn't apply to transfers via banks, including payments using credit cards or debit cards. So if you want to avoid this tax, open a bank account. U.S. citizens who provide proof of citizenship may claim a refund or a credit for any written remittance transfer tax that they pay. Non-citizens aren't entitled to a refund. Effectively, immigrants and expatriates are penalized for using non-bank money services. Okay, so that's all the slides. So there's one more thing that I wanted to mention before we finish up here, and that's that I haven't covered everything. Sorry about that. I covered most of the major points, but particularly there are uh, rules that have been changed or adopted for people who have offshore income, foreign income, or they're operating a business overseas, and so forth. So for businesses in the United States that are foreign owned. So for those, you should be consulting with your CPA or tax advisor um, if you have that type of a situation. But thought that that wouldn't apply to that many of the people that would be watching this video. All right, folks. So good luck with these provisions. I hope you got maybe a break here that will help, at least by having the tax rates reduced. The extension of the low tax rates under the Cuts and Jobs Act, and by having the higher standard deduction that even low income people can benefit to some extent from these changes. So if you have questions, see your tax advisor. You could send me an email at mgray@taxstreamers.com, but I'm kind of limited as far as the help that I can give. And so I wish you well and have a happy holiday season.